Welcome to the source of commercial real estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I'm your host, Jonathan Hayek. I'm a former public school teacher who found financial freedom through residential real estate investing. And now I invest in commercial properties, particularly small industrial properties. And today we are talking with Frank Forte. He is the Chief Investment Officer and founder of the private equity real estate investment firm, Lucerne Capital Partners. Frank formerly worked for the Department of the Treasury. He's an experienced real estate investor, and he's closed over $300 million in transaction volume. So this is certainly going to be a great conversation. Frank, thanks for joining me. How's it going today?
Yeah, no, thank you so much for having me and going great and excited to talk to you about my passion, which it appears you share. So looking forward to it.
Frank, let's start the conversation with you telling us more about your background and how you found your way into real estate.
Yeah, sure. So as you mentioned, so I kind of graduated college years ago. Finance was always what I had intended to do. Always thought I was going to go to Wall Street, be an options or commodities trader. High math aptitude, always kind of had that. And real estate was something I always thought I would do later in life, right? Kind of perhaps how you said your journey was, where you came into real estate later. And sort of graduated college in the middle of the financial crisis. Was not really a lot of jobs, and I ended up taking a job with the U.S. Treasury, taking banks that had failed and merging them together and closing other banks down to protect the depositors who had, done, fortunately, had been in a tough situation with a lot of the bank failures. So I did that for a few years. It was very interesting. The pay was, terrible, as you can imagine, being a government adjacent employee. And ultimately, I left and I started to work my way to private equity. I worked for a senior housing debt and equity company, ironically, down the road from now where my business is now. And we were buying and selling senior housing facilities. So skilled nursing, assisted living, drug and alcohol rehab, really interesting stuff. And it was kind of, again, not fully where I wanted to be in real estate. It was, senior housing is a business within a business, right? Much like self-storage or other businesses where real estate is just investment, right? Car wash, what have you. Left there after a few years and went to go work for a company called Fortress and a company called CW Capital on turnaround and ultimate disposition of an asset called Peter Cooper Village Stuyvesant Town. And that is the largest commercial default in history, okay? Largest CMBS default in history. 10,000 creditors, whatever, Church of England, Vatican, Singaporeans, all these people, right? And it was crazy thing, 11,241 apartments, 7 zip codes, 30,000 people live there, mind-blowing size of this property. And then ultimately I landed at a company called Berkadia. I was a banker. We were doing about $2 billion a year out of the New York office, which was our headquarters. About 85% of that was apartment related debt and equity. And then another 15% was all sorts of commercial, office, industrial, retail, whatever, medical office, etc. Always wanted to go out on my own, kind of start my own gig, and was looking for partners. I had the experience and the know-how, but I needed investors naturally, and met 2 gentlemen, one of which is still my partner today. The other one is, since moved on, older, different cycle of his life. And we started Lucerne. I started in 2016, and these guys joined shortly after. And rest is history. Started in the multifamily space before people got into that, where everyone and their mother sort of piled into that space. It was well before that, and we started investing in the Southeast. Saw what a lot of guys were doing when I was banking at Berkadia. Valuations were much different than they are today down south, and so Charlotte became a main kind of ground zero for us, along with New Jersey and some other markets in and around New Jersey, Philadelphia, the like. So and none of those markets we still operate in. We own a small bay deal here in Jersey, but for the most part, apartment investing in those markets is really difficult. So all that to say, we made a lot of money in the Southeast in apartments. And a few years ago, we sort of started to see the tide change. Valuations were coming down. Things were getting overbuilt. and the apartment space had become really, really difficult to operate. We still own some of that product today, but most of it we've divested. And we ended up building a small bay deal in New Jersey, which is like an act of God, right? It's like a divine intervention. And because in New Jersey there's like a joke that it's only through divine intervention can you change zoning. So we had this stroke of lightning, and it's a crazy story, but we ended up building this thing for well below probably half of what it would normally cost, given the seller. It's sort of a sad story, whatever, but we ended up doing really well on it. We said, hey, why don't we do more of this stuff? And, why don't we do this stuff in the markets we know best in Charlotte and the Southeast, because it's markets we've been in 7, 8 years, some of them. Started looking down in Charlotte, bought our first property about 2 years ago, small bay deal, $117 a square. We bought it for. The rents were like, 9 gross. We're now in the low teens net. I just signed a lease at 20 net. So absolutely, hitting the cover off the ball. And then we kept buying and bought another deal in Charlotte, another deal in North Carolina. We just bought a deal outside of Washington, D.C., the Baltimore Washington corridor, right on Route 1. And, DMV was an area we wanted to get into for a long time. High density, high supply, barriers, and so on and so forth. So that is kind of takes us up to today. And, we sort of, apologize, just plugging in my computer here. We sort of, had a really interesting path, but a lot of the fundamentals we see in small bay are the fundamentals that we saw in multi years ago, right? Fractured ownership, a lot of mom and pop, diversity of cash flow, poorly managed, and in need of people to come in and do a better job, support small business, but ultimately use it as a vehicle to generate cash flow and upside. So that's sort of my journey into real estate. I could go on forever. You don't know me that well. I could talk for a very long time. So I'll sort of cut it there and any feedback or any comments or questions.
So it sounds like Lucerne started in the multifamily world, and now you've shifted to the small bay industrial world. You mentioned something pretty interesting. It sounded like your first small bay industrial deal was a hairy development deal in New Jersey.
Yeah.
And it sounds like there's a little bit of a backstory there. You built it for much less than what other people could typically build for. Will you tell us the story about that first development deal of that small bay property?
Yeah. So it's a little sad of a story in a weird way. So I'll share it with you. So an investor of ours, longtime investor of ours, called us and said, "Hey guys, look, there's this plot of land. It's got a lot of the site work done. It's in Howell, which is core Monmouth County where we are, because we're based here in New Jersey." And he's like, "Look, you can get the land really cheap, and it's got approved plans for 35,000 square foot multi-tenant deal." That was before people were calling it small bay a couple of years ago, right? People just called it multi-tenant. And he goes, "It's got approved plans, half the site work's done, and you can get it for 30% of what unentitled land goes for." And I'm like, what's the catch? Seems too good to be true. And he goes, "Well, there's no catch." He goes, "The guy lost his legs to diabetes." And he goes, he was a site work guy by trade, did this. This was going to be a side investment for him. And ultimately, can't build it and whatever. So he goes, "You want to go meet him?" I said, "Yeah, let's go." So we go, and it's in the depths of COVID, right? So it's the winter. We go into this office that was an old train station from the 1800s that had been abandoned. This guy bought it, converted it to his office, right? Like one of these like war buff, sort of like nostalgic guys, right? So he's got all this crazy stuff hanging up about Battle of Gettysburg and, Civil War, all this crazy like war memorabilia. And he's sitting in there with all the windows open. It's 20 degrees out. The wind is rushing in and out, right? It's like out of a movie. And he rolls out from behind the desk, and he has no legs, right? And you're like, "Oh my God, the story's true," whatever. So we're sitting there, and we're all sitting like at this crazy distance or whatever. And he's sucking down Mark Reds, right? Like just ripping them down. And he's talking to us, and he's like, "You guys want to build this thing, whatever, blah, blah, blah." And I go, yeah. And he goes, you come, you're in here, you shook my hand, you're looking me in the eye. He's like, I like you. He's like, I want to do a deal. So we end up striking the deal right there. And some of the other more you know, juicy details of that conversation I'll leave out, probably not for public consumption, but we ended up buying this land really cheap with half the site work done. So we ordered all of our material up front, and we got about 80% of the way through the build, and we couldn't get electrical panels. This was during COVID, and we were waiting. We were in queue for over 50 weeks for electrical panels for this property. And a week before they were supposed to come, they called us. They're like, it's going to be another 50 weeks. And we're like, we are spending X amount in interest a month on interest carry for panels that normal cost is $4,400 a panel, right? And the way the buildings are, they're kind of staggered. So there's one main panel for this and one. So two of these panels, right? Less than $10,000. We go on eBay. They're on the black market on eBay for $35,000 a panel, right? So this was like when all this crazy stuff was happening during COVID. We're calling everyone we know, get us a panel. Can we modify a different panel? We even looked at, do we change all the conduit and rewire the building for a different size panel, which was readily, all this crazy stuff. And I ended up having a personal relationship. So one of the panels we found, and we sourced, and then we need a second panel. So now we're like, all right, do we reroute the main panel to the other building so that we can get some tenants in and make it operational? We're talking to the city. They won't allow us to do it. So we're doing all these different crazy machinations to try to solve this problem. And a close friend of mine's a CEO of a very massive electrical supply company in America, 200-300 million of revenue a year. And I was waiting like the last ditch thing to call him, right? Because you don't want to call it a favor over $4,000 panel. And I call him, I get him on the phone. I'm like, hey man, blah blah blah. I'm like, can I, do you have these panels? He's like, he laughs. He's like, you and everyone else needs this stuff, whatever. Can't find it. He's like, I can't promise anything. And 2 weeks later, a panel showed up at our office, and don't know where it came from. Don't know who we unfortunately skipped, but we got the panel finally after months of waiting. We were able to finish the construction. The silver lining, though, was we had pre-leased the property back then at about, I think it was 1050 or 11 triple net. And while we were leasing the property, a couple different things happened. One, obviously we had this delay, which sort of stopped it. Two, the township and a lot of the townships here put a moratorium on new warehouse development, which is really designed to restrict the bombers, right? Not the local HVAC guy who needs space. So that put a lot of upward pressure on rent. And then last thing was, the depths of COVID, and all these guys needed space, right? Who's doing this business, selling this on Amazon, doing that. And it put so much upward pressure on rents. So we ended up having to release, we had the entire building pre-lease, we ended up having to release all these tenants because we couldn't deliver because of these panels. Well, when we went back to market to release, we ended up leasing the rest of them at between 1550 and 16 triple net. So we absolutely smashed it out of the park. We ended up refinancing, pulling some cash out with very low leverage, and ultimately turned out to be a huge success. Beautiful building. But it was just kind of this crazy, winding turn of events. And the truth is, we're not developers by trade. We've done some development. We've been successful at it. It's hard. Development sucks. And, it's really difficult to make the numbers make sense, especially on shallow bay. Like, had we not bought that land for what we bought it for, the deal would never make sense, because back then we didn't know the rents were going to be 16, right? 15, 50, 16. We thought they were going to be 11, 12. The numbers would have never penciled. We would have never put the shovel on the ground, never bought the land. So it was kind of this interesting twist of fate. And it kept getting better and better. But I prefer, which is maybe a great segue, I prefer buying beat up stuff, fixing the ops, fixing the property, and moving the rents. And to me, that's always been a better basis buy and a better path to execution. And that's a lot of what we do now. Everything we do is value add.
Talk me through, a little bit more of the kind of properties that you're looking for. So value add, what about size of property, number of units, bay size, that sort of stuff?
Yeah, sure. It's a great question. So, a couple things. One, I think, we have pretty deep amount of equity between personal equity investors, and then we have some other larger, institutional groups that have, put money in our deals. So, size, we can take down a lot of different stuff, right? If I were a broker, I'd say, hey, shoot me anything that you think is good and multi-tenant, shoot it to me, and I'll say yay or nay quickly, which is always a hallmark of what we do, right? We always respond to people. We always give them feedback super quick, right? And that's a really good practice for anyone that's listening to this to do if they don't already. And a lot of people say they do, but they don't. They'll let emails sit. It's always good to get back to people quickly, and you'll always get more deal flow. Realistically, I think what we want to be buying is 10 to 15 million and under, because that's stuff that's likely not been picked over by folks previously or been picked over by any larger players. There's not a lot of people doing small bay. There's a lot of fervor out there about it, but like I will tell you, there's not a lot of people actually doing it. Right? We have 400,000 square feet at this point in the last 12, 18 months. We've scaled a multi-platform before. At one point, we had 200 million of multi-product that we owned. We're going to scale this, but again, the truth is, a lot of people say they're multi-tenant guys or whatever. They get in, they do one deal. If 3 or 4 tenants, they get pissed off. I used to have a couple thousand tenants when we did apartments. Having 40 doesn't bother me, right? I had one property or two properties, right? So we have over 100 tenants now across our sort of little nexus. So we are looking for deals in that size range, 10, 15 and under. Particularly bay size is really, really important. So I want to kind of dispel like this like new thing that's out there. So now that there's all this stuff about small bay, people are like, anything that's 25,000 square feet and under per unit is small bay. Like, no, that is not correct. Never was correct. And I don't think you'd find a single person who's really investing in this stuff saying, I can't wait to buy, 125,000 square foot property with 5 bays. Like, let's go small bay. Like, never happened, right? So for us, we're really looking for suites that are a couple square feet, a couple thousand square feet and under. Those are true small bay. We've noticed in the markets that we play in, which are all high growth and high barrier to entry markets, that once you get above, it's called 2,500, 3,000 square feet, the rent levels really fall off, right? So if you draw a graph and you say, okay, the bigger it is, the rent goes down, right? Here's this and here's the rent, it goes down. What you find with the small bay stuff is on the really small stuff, it's here, and then it goes off the cliff. It's not really a linear representation of kind of how the rents correlate with size. So you want to be in that smaller segment because it's got the highest torque on the rents. You also want to be there because it's really simple, right? If you're a tenant, let's say you own audio visual company and you store all your equipment there, or you do processing there, whatever it is, you don't really care about per square foot, right? You come to me, you say, Frank, how much does it cost to rent this unit? What am I getting? And do I have to pay any CAM? Whatever. That's all you care about. So I might tell you, hey man, it's $2,000 a month, but that might be $1.50 a foot a month, $18 triple net a year, right? So you want to be in that sweet spot where you can have notional rent conversations. That's how you really work the rents, and where you don't have too much torque. There's also kind of some interesting aspects of these things where you're looking for docks, right, or drive-ins, and that changes the tenant base dramatically. And there are certain size ranges, for example, where if you don't have a dock, you're not going to get a lot of torque on the rent. Or if you have a drive-in, you're only going to get up to X guy. If you have a parking or truck court that's too small, you're never going to get that higher rent, because once that guy's business gets to that point where he can support that rent, well, now he needs a different form of delivery and your property can't accommodate it. So there's all these little nuances that you sort of pick up on over time. And yeah, we just try to look for good properties in good areas. I don't want to buy tertiary stuff. Not interested in that. I think it's worth it to pay up a little bit if you have to pay up a little bit to be in a more major market, because the truth is the supply is dwindling of small bay. It's increasingly demolished and taken out of service for apartment product, right, or other fancier, higher use case development. So that's kind of what we're looking for.
With these value add deals that you're looking at, these are, older properties, they've been mismanaged, there's probably some deferred maintenance. What are some of your top due diligence items that you look at and address during your inspection period?
Yeah, sure. Great question. For the shallow bay and small bay, you obviously want to look at the interior. A lot of times we don't need to provide TI packages, right? Because these people don't have anywhere to go with tenants. So they'll say, hey, man, no problem. This wall's banged up. Like, I'll fix it myself. Oh, I'll paint it here. Don't worry. I'll epoxy the floors, Frank. Don't worry, right? So I'm not so worried about that. You want to look at the condition to understand what it looks like. But the big items for me are always threefold. Assuming the building structurally is sound, right? Take that out of play. Let's just pretend there's no issues there. You look at the roof, you look at the HVAC if it exists. Some small bay it does, some it doesn't, right? Depending on if it's conditioned space or heated or neither. And then you want to look at the parking lot. The parking lot with small bay, especially if you have automotive tenants, it tends to get beat up really quickly because you have a lot of traffic in and out with a lot of tenants, and they're beating up the parking lot. So you look at the parking lot, you look at the roofs. Metal roofs generally last a long time. They've gone up considerably in price, which is a really big problem. So there's a lot of these small deals you see that the roof repair. Let's say you see a small deal, it's $1 million deal, and I'm just coming up with something random. $1 million deal, 10,000 square feet. Well, you replace that roof, that's $100,000 roof in today's environment. It's $10 a foot. So you're going to add 10% of the deal on in basis in the roof. Like, no, you got to get the deal for less. So the roof has become a really big thing. And then HVAC, like a lot of these tenants we've seen, a lot of the leases require the tenants to upkeep the HVAC, right? Even on small way. But a lot of them, landlords don't enforce it. So what ends up happening is you get a guy who's been in the space for 10 years. He doesn't want to pay for the maintenance contract on the heater. He doesn't use the heater in the winter because he doesn't want to pay the heat bill. And before you know it, the thing's totally shut, right? And then, foisting a brand new $7,000 heater on this guy, he's probably going to tell you, go F off, right? So then you're left with waiting until he leaves and you get forced with that replacement cost. So quickest and easiest way is obviously don't ever get in that situation, right? And maintain the thing so they last. But unfortunately, you're not so lucky, right? When you step into some of these deals. So we take a hard look at HVAC, roof, and park. Those are the main items.
I've seen just on your gas thing. I was smiling. The heater thing. I've seen tenants actually have the gas company come and remove the meter from the building so that they're like, we don't use the heat, we don't want to pay for heat, and so we just had the gas company come and they just removed the entire meter from the side of the building.
I'm dealing with it now, not with the meter, but this property we just took over in DC. So it's an automotive based property, right? All auto tenants. And I like it. It's a contrarian play. It requires you roll your sleeves up, but we're good at that. We've been successful at it before. And, we have all these gruff, older auto guys, right? And they don't want to pay for anything. They're on there in big coats, right? It's 20 degrees. They have hats on, they're working or whatever. I'm like, why don't you guys just turn on the damn heater? Like it's like 20 degrees in here, right? And they're sitting there and they're going like this, they're doing stuff, and they're like, no, we don't want to pay for the heat. And so then Steve, who is on our team, handles a lot of our property management. He's really great at what he does. And he goes down there and he's talking to this guy. He goes, hey, you got any complaints with the unit? We always do an original walk, not tenant interviews, but then after we take over, we actually do a walk to find out what's wrong and to address the problems, right? To get on a great foot with the tenants. He goes, oh, my heat's out. And he's complaining. We sent a tech there to fix the heat 3 days into owning the property. He goes, no, sends this guy away. They want him to charge us a service charge. They're all pissed off, right? This HVAC company. And this guy sent them away because he's complaining about the heat. And then we go in there to fix it. He's like, no. And it turns out it's capped. The gas thing is capped. It's just like you deal with these like weird hijinks and with these people. And it's, it's really, it's very comical. Some of these things you deal with, but they're really, I mean, at the end of the day, they're small mom and pop businesses. They watch every nickel, and they're just like, it's very funny how some of these things turn out and the mentality of this. So always interesting taking over a new property and dealing with tenants that have been there for a while, especially at a property that's been mismanaged because they've either been treated poorly, so they have a very negative view of the property, right, or of management in general. So turning that tide takes some time, takes action, or they've been given so much leniency that they like, kind of having this loosey goosey environment. And then when you go in there and you try to create framework, they're like, oh, no. Like, that's not how it's always been done. It's like, well, that's fine, but that's how we're doing it now. And eventually you earn those people's respect, but it's hard. They're very, distrusting of new management.
Frank, continue with the scenario you started talking about earlier with the roof. Let's say there's this $1 million property, you like it, everything is great, but then you have the roof inspected by multiple roofers. Every roofer says this roof is, it doesn't have any life left on it. You've got to do roof and gutters. The price tag is 100K. You look at your numbers and you're like, the numbers just don't work with putting in another 100K to this property. What's your course of action in that scenario?
Yeah. So my first course is to try to not be in the situation to begin with, right? Like kind of best offense is defense. We live in a world now. You got Google Maps, right? You got Google Earth. If you're familiar with some of these markets, right? I'll send the GC to some of these people's properties to fly a drone over. Not the drones that are over New Jersey currently. a toy drone, and fly it over and take some pictures, because the truth is you don't want to start spending money and then feel like, oh, hey, we're into this already for another 10 or 12 grand on DD or 15 grand, whatever it is, travel costs, legal, only to find out you have this thing and the seller's not going to come off of it. So the best course is I try to not be in that or get in front of it, ask the right questions, try to figure it out. And I try not to be in it, but unfortunately, sometimes it happens. And like, I'll give you a great example. So we don't buy a lot of iOS sites. It's not really our interest level, but I did have one tied up in North Carolina earlier this year. And it was a truck terminal, beautiful buildings, tall ceilings, gorgeous doors. I mean, really nice stuff. Right off of I-85, backbone of Southeast, like absolutely killer. Everything about it was amazing. We thought the roof had some issues. We weren't sure the degree of the issues, but we had this thing tied up at a ridiculously low price. We're like, fine. So we go in there, and it turns out the roof is way worse than what we thought. And part of where this was, it was an area that it's this weird service road off of 85. So there wasn't any street view. All the preemptive things I usually do, I couldn't do. And it was a little too far for our GC to drive there. I don't want to make them drive 45 minutes to take a drone video of some random building we may or may not buy, right? So all the usual things we do, we didn't do for one reason or another. And we had to move quick to tie it up because it was a really low price. So long story short, not only is the roof shot, one of the roofers that had gone there, we had 3 people went. One of them had gone there, and it was raining out, and he said it was literally raining inside the building, like totally shot. And then we found out between the metal decking and the top of the peak, there was all this mold as well, because this issue had clearly been going on for a really long time. So unfortunately, we dropped it. We tried to trade them down on the roof, right? I don't like retrading. We seldom do it unless we have a real reason or we've been misled, deceptive, whatever type of action, or you just find something that's untenable. I tried to work with them. There was enough room in the deal. I was like, look, we'll do half the price of the roof. Like, we'll split it. Like, I tried because I wanted to make the deal work, and there was a lot of room in the deal. And they told me to, go screw myself. And they actually ended up putting it under contract with someone for a higher number who's willing to do the roof. Testament to us being able to source it cheap. But truth be told, for me, it wasn't worth the binary risk of leasing it. It was probably a 9 to 12 month downtime, but it was the type of thing, and these weren't the numbers, but the type of thing you buy for $1 million, you tenant it and it's worth 2, right? Really good trade. But you sit there with a no cash flow situation for a year, could be longer. This was in the summertime. You didn't know what was going to happen with the election. Who's going to win? Is it going to be business friendly? Or taxes going to be bad? Are we going to hit a recession, right? All these little things floating out there. What are interest rates going to do? So it just wasn't worth the risk for us. And to my knowledge, it still hasn't actually closed. But, that person's going to have to redo the roof, and the roof was expensive. This is not a big building, and it was 180K for the roof. And part of it was the decking and everything also had to be replaced because it was all shot because of so long. It's like the HVAC problem. It goes too long, the cost goes up dramatically because a little bit of maintenance goes a long way, but it was never maintained, right? So anyway, that would be my course of action. But best offense is defense. You try to get ahead of that stuff, and especially if it's a market you know well, get someone over there, fly a little drone over, whatever. Do whatever you can to get a real good understanding before you get in there.
Talk to me about management of your properties. You own a lot in the Southeast, North
Yep.
Carolina. You live in New Jersey. Are you managing your properties from New Jersey?
Yeah. So we have 2 different methods of management. Method 1 is we have a third-party manager who's really excellent that we use and we've used for a while. And the first couple we bought and they manage it because this was before our platform was really scaling up. Last couple of years, transaction volume has been low, so we weren't going to kind of spin up a management company for a couple of assets. We have people on the ground in North Carolina. The newer assets we've been purchasing, we self-manage. And it is intensive in the beginning, for sure, taking over and doing all that. As you kind of stabilize the asset out, and you do good work, and you begin to get the asset where it needs to be, the resource utilization decreases. We try to make everyone pay online. Obviously, that's from my mouth to God's ears, right? And not all these people want to do it, but you try to get people to pay online. We assemble a local team, which is what we're doing. We're building that right now outside of DC, right? Because we're new to that market. But for Charlotte, for example, I have so many contractors and vendors and all these people we can look to for favors, or we get paid to do stuff, or drive by here, do this, do that. It makes it much easier. So we use an online property management software called Rent Manager. It's one of the oldest softwares out there. It's been around for 40 years. We use it to do accounting. And you can do tenant communication through there. You can do all this stuff. And we sort of get in, right? And we assemble our team, and you try to find a couple of handyman type guys. You try to find this guy, that guy, and you get like kind of all your team in place. And then you go there and you start to tackle stuff. So we do manage. We've been successful at it so far. We obviously managed the deal here in Jersey. And yeah, we've been successful at it so far. It's definitely for people who are not used to more than one tenant. So the biggest pushback you get is from the old school industrial guys who do single tenant. Like, oh, that's the benefit. Like, it's one tenant. It's like, yeah, it's one tenant. If that tenant goes out, like, it's also a really binary outcome. And if inflation or rents are up, right, you're locked in and you don't kind of keep pace, and that gap widens until the mark to market's like wild. But for me, I always looked at it as like, we've had 1,000 tenants before plus. So having 100 is like a freaking cakewalk, right? And, some of these people have several units. Some of them are really, we have one company, for example, I won't say where they are or what property they're in, but they do about 10 million a year in revenue, right? And they're a supply company for industrial stuff. And, these guys are never not paying their rent, right? Their rent is probably 0.5% of their, top line, right? And they're growing so big, they're probably, at some point, I'm sure they're going to abandon our property and probably have to get something of their own. But, I have guys that do e-commerce, all this stuff, and most of these tenants don't bother you. What you find is it's the legacy tenants of these properties that are the squeaky wheel that needs the oil, right? Because they're people that, like I said, they fall in one or two categories. Either they were super lenient on those guys forever, so now they're pissed off that you're clamping down on them and you're trying to run a better shop, or they were mistreated for so long, they don't like you, they distrust you, and you got to earn their respect. But those are the people that complain. For the most part, the new tenants who put in, who can pay the face market rent, are people who have a better operation, right? Because the rents are now higher. So it requires a much better business acumen to be able to cover that and make money. So you find those guys are better business operators. It's kind of like you can see the different grades of operator. You can see it when you go in their space. Guys that have stuff hanging from the ceilings, crap everywhere, whatever, and the guys who go in there and it's an auto guy, but you can eat off the floor, right? Like, that guy knows what he's doing. Different than two dudes in there with wrenches and a little bit of auto flow here and there. Totally different business, right?
Frank, this has been a great conversation. I've really enjoyed hearing about your business model, and I really admire your background and your history and how you've built these businesses. I'd love to have you back sometime. If listeners want to connect with you or learn more about Lucerne, where would you like to send people?
Yeah, sure. So you can go to lucerncapital.com, LUCERNCAPITAL.com. Alternatively, if you'd like, John, when you post this, feel free to post my email and contact info. If you want to talk about deals, or you have a deal, or you want some advice, I'm always happy to connect with folks. And listen, it's a great space. I would encourage anyone who's interested in it to really dig in and understand it, because I think people have this existential wave starts to feel like it's coming, like what multifamily was in 2016 and 17, where all these people think this is the next hot thing. And there's a difference between someone who's an investor and someone who just rides the wave. And I was in institutional real estate before. I've seen this happen but we know how to operate. We know how to do this stuff. And there's a lot of people out there that think, hey, I want to go raise a couple bucks and buy this stuff, but they don't understand kind of the tenant requirements or demands or what makes a building good or not. And I'm sure you've seen some of these people. And I feel terrible because, you don't want these people to go out and not be successful. But I would say to anyone who's interested in real estate investing in general, even a small bank, get educated, do your research, take time. It'll only benefit you in the end. And it may seem like it's like the next hot thing. The truth is, there's not a ton of people in it. It requires a lot of rolling your sleeves up, but there is opportunity. And do your research, do your diligence, and yeah, good luck.
Good stuff. Thank you so much for joining me, Frank.
Thank you. Have a nice day.
Listeners, if you enjoyed this conversation, reach out to either one of us. We love talking about commercial real estate and we would love to connect with you. Thank you so much for listening. We appreciate you. Until next time.